Recently, Peter Schiff has been looking over on mortgage applications. The purchase index dropped 8%, which follows a drop of 3% the previous week. The refi index also fell by 9% following an 8% drop the previous week. Refinancing and home purchase loans are failing, which could have serious consequences for the economy. Now, if you want to know more, this is the Financial Bridge. And for today's video, we'll be talking about Peter Schiff's alarming news for us about certain troubling developments in the mortgage and refinancing markets, which might have far-reaching consequences. But before we continue, please make sure to give this video a like and subscribe to stay updated for more of our content. Now, without further ado, let's begin. To begin, why did Wells Fargo's home loan division just announce massive layoffs? When homeowners can refinance their mortgages, there's no need for as many mortgage brokers. Since the current mortgage interest rate is so high, 5.5% give or take, in comparison to historical norms, no one can refinance into a lower rate because everyone already has a better rate. Because you can only refinance your mortgage if the result is a cheaper payment, this financial lifeline has been a vital lifeline for the economy, providing households with a source of money. Furthermore, if a mortgage refinance results in a lower monthly payment, the homeowner will have more discretionary income after housing costs have been paid. They can now afford to do things like go shopping, further contributing to the gross domestic product. This aids the economy as a whole, but it especially helps the industries that receive the money. This has been beneficial for a consumer-driven bubble economy. Mortgage payments can be a significant portion of a household's income. If that expense could be reduced, consumers could put that extra cash toward other purchases. No longer can individual homes do that. You are stuck with the terms of your mortgage. There are still a number of people with adjustable rate mortgages, so their payments won't be decreasing for them. Maybe 15 to 20% of mortgages are adjustable, and they don't have to be adjusted every year. Many people have 5-year fixes that reset after first 5 years. A large number of customers made this decision 5 years ago. Now, they're approaching the end of their adjustment period and facing much higher mortgage payments. So they have less money for food, less money for petrol, and since both of those things are getting more expensive, they may have to cut back on other discretionary purchases, which is why many consumer discretionary stocks have been struggling. However, the circumstantial data already points to a faltering economy. In other news today, manufacturing activity has been worse than expected, despite expectations that the Kansas City Fed Manufacturing Index would rise to 39. The actual figure was much lower than expected, coming in at 25%. So, looking at the GDP statistic that supports this now, there is abundant evidence that the economy is considerably weaker than anybody assumed. The United States' record trade deficit was a major contributor in the slowing GDP. A new term, goods deficit, has been coined to describe our trade deficit in consumer goods. Given that this was the last month of the third quarter and we had the advanced estimate, the decline was expected. Those numbers only account for merchandise, not the surplus in services that helps to offset the total trade imbalance. In contrast, this manufactured substance is the real deal. Now, do you remember when Donald Trump promised to make America great again if he was elected president? As for the reason for our goods trade deficit, the culprit was the industry. To reverse the country's decline in international competitiveness, he ran on a platform of restoring American manufacturing and the nation's industrial foundation. These massive trade imbalances are to blame for the fact that the trade deficit did not narrow as predicted by analysts, but instead soared to a new all-time high of $125 billion, smashing the previous record by a wide margin. No one has ever seen a number like this, and the market's response when the dollar rose is the only thing more incredible. If such a number appeared in the past, before the advent of computers, the dollar would be doomed. Instead of the expected reaction, the dollar strengthened and gold fell on the report. The markets still have no idea what's going on. Currency devaluation is the conventional method of reducing a trade imbalance, and therefore it seems to reason that a country with a deficit as large as this one would be subject to such measures. The collapse of the currency makes it such that the country can no longer afford its many imports, but the resulting drop in the cost of its exports to foreign buyers helps restore equilibrium in its trading relationships. However, Unlike other countries, the United States is not subject to the same level of discipline due to our reserve currency status. Do you see how we managed to import goods to the tune of 125.3 billion without going bankrupt? It cost us a lot of money, but we paid for it in dollars. We brought in goods and sent out cash. One of the United States' most valuable exports is really worthless money. Since we only print them and make them up, they are worthless. Everything from factories to machinery, to laborers to land, to a wide variety of raw materials go into the making of the completed commodities that Americans import. What are we offering our commercial partners anyway? They are arbitrary numbers that we make up. As for now, no one understands why they are acting like that according to Peter Schiff. Where are all these billions of dollars going? The question now is what they plan to do with their newfound $125 billion. What we're going to do with all the stuff we just acquired is use it to improve our lives, have fun with it, and enjoy it. There must be a better use for all this paper than just sitting around, right? In any case, they're not going to let it go. However, the more of our paper people purchase, the less valuable each additional copy becomes. It will fall apart eventually. Right now, as investors flee Europe and Japan, the dollar gains ground as a safe haven. This is a massive bubble, and it will burst sooner or later. When reality finally sinks in, the higher the currency rises, the more spectacular the fall will be. When do you anticipate the breakthrough point, as shown by most recent data? There has been a dramatic drop in the number of people applying for new mortgages, by some estimates as much as 40%. According to the International Monetary Fund, interest rates should be 1% above the rate of inflation. To put it in another way, if we are at 8% now, we should be charging at least 9% in interest. 1% above inflation is not enough of a return in my opinion. 1%, there are negative interest rates everywhere. I believe they are the most negative here due to the highest inflation. Since our inflation rate is higher than that of Europe or Japan, our nominal interest rates are higher, but our actual interest rates are lower. The true inflation rate is far higher than the unofficial rate. But hey, mortgage rates are back up to around 5%, which is still rather cheap by historical standards. However, they have dropped much below 4% in recent years. I mean, people were obtaining mortgages below 3.5% on 30-year fixed. And if you look at home prices, which have increased by almost 20% annually, you'll see that both home prices and the affordability of purchasing a home are at all-time highs. The low mortgage rates are the only thing keeping these inflated housing prices somewhat accessible, and that's before interest rates rise. However, if we lose these low mortgage rates and they rise to, say, 7 to 8%, as they were before the '08 financial crisis, we're back where we started. If home prices don't fall, no one will be able to afford to buy a home. There will soon be a sharp decline in home prices. However, new construction is unlikely since rising inflation makes it too expensive to construct homes. So it looks like we won't be getting any new houses. You'll have to buy an existing house if you wish to live in one. There will always be a price cut if someone wants to sell you a house but you don't have any money. Since many people may no longer be able to get mortgage financing, the real estate market could shift to becoming cash only. But when do you anticipate the Fed getting to that interest rate? Markets and the economy will definitely crash as a result of this. The market is already broken, according to Peter Schiff's perspective. We haven't collapsed yet, but he expects that to happen soon. There is no doubt that the bond market collapsed. But if we look back to 2018, we can see that things really started to go downhill in the fourth quarter. In my memory, the Fed raised interest rates to around 2.25% before they were forced to halt increasing and quantitative tightening, sending rates down to zero in the GE. When it finally does happen in March of 2020, using COVID as an excuse, Peter Schiff anticipates a considerably lower breaking point than in 2018. In other words, the impact and increase in interest rates are magnified the deeper in debt you are. The smaller the percentage increase that produces the same result. Therefore, the economy is increasingly levered up and reliant on cheap money due to the increased debt level since COVID. If that currency loses some of its purchasing power, the collapse will come about more rapidly. It's like we've developed a much more severe drug addiction, and because their tolerance to our monetary heroin has increased, we are doomed to have relapsed and withdrawal instances much more quickly than before. An increase of 150 basis points in interest rates could be sufficient. Since rental income is down and it's evident that more individuals are going to work from home, the commercial real estate industry is being kept afloat solely by cheap money. Since fewer individuals are making purchases, the commercial real estate market will suffer, as will the retail sector. Due to inevitable decline in the value of the dollar, they will be unable to afford the store. People can't afford to shop at Walmart like they used to, so it's becoming more like Saks football, and those that do shop are more likely to do it on Amazon or another online marketplace. Stores in enclosed shopping areas like malls and centers are suffering as a direct result of their customers staying at home. Financial institutions providing loans to property owners who subsequently fail to make their payments are also at risk. That means a major crisis is on the horizon. Farmland, resource-rich areas, and suburban lots are the types of property most likely to increase in value. Many people are leaving these dangerous and expensive cities in search of safer ones where they can avoid getting a job altogether by doing remote work. Therefore, there is a clear contrast between urban and rural housing markets. Based on current market sentiment towards inflation in the Federal Reserve, the markets are in the eye of a storm. The markets continue to have faith that Fed will be able to successfully combat inflation, and that the significant increase in inflation will prove to be temporary. The market expects inflation to remain at about 2% or lower for the next 30 years, as seen by yields on 30-year bonds. But the changeover period is longer than they may have originally bought. Markets still expect low inflation over the next 30 years, despite these massive deficits, as evidenced by the spread between inflation-protected and regular treasuries. Investors also believe that the Federal Reserve can keep printing money and expanding its balance sheet indefinitely without ever experiencing higher inflation. Peter Schiff believes the markets will soon have to accept the fact that the Fed is doomed in its battle against inflation. The political concessions that would need to be made in the short term to the economy, the labor market, and the government budget deficit make it questionable as to whether or not it even has the stomach to go head-to-head with inflation. Reason being, if the Fed takes aggressive action against inflation, the United States government will be obliged to make severe cuts to social programs like Medicare and Medicaid. Since the Fed would rather not force politicians to make unpopular decisions, it's likely that we'll revert to GE and see further rate cuts despite persistently high inflation. Even if the economy experiences a downturn, inflation will persist, and this fact will eventually be reflected in the market. Many individuals believe that a recession will eliminate inflation if the Federal Reserve fails to accomplish so by raising interest rates to a high enough level to trigger a recession. Since we will have less economic activity during a recession, but we will print even more money, inflation will rise. In contrast, once the market realizes how severe inflation is going to be, an unprecedented influx of capital will drive gold and silver prices over the roof. Nevertheless, this concludes our video for today. Now, if you have any thoughts or questions you'd like to share about Peter Schiff's warning, then don't hesitate to leave a comment below, and we'd be more than glad to join in the discussion. Other than that, we thank you so much for watching. Please make sure to give this video a thumbs up, and if you'd like to see more of our future uploads, then kindly click the subscribe and bell button for more of our content. Once again, this is The Financial Bridge, and thank you so much for watching. See you soon.